So imagine trying to invest in like the massive, world-altering boom of artificial intelligence.
Right, the AI boom.
Yeah, and your first instinct is probably to look at, silicon chips or those sleek hyperscale data centers.
Sure, or the software companies actually writing the algorithms.
Exactly. You picture these sterile, temperature-controlled server rooms out in Silicon Valley. You almost certainly do not picture rusted steel pipes buried under the mud in South Texas.
No, definitely not the first thing that comes to mind.
Right. But welcome to a special Talk Tickers edition of The Deep Dive. Our mission today is to rapidly extract, the most crucial intelligence from a recent corporate earnings call.
We're going to translate the Wall Street jargon into plain English.
Yep, and deliver an actionable, data-forward verdict for retail investors. Today we are looking at Kinder Morgan, that's ticker symbol KMI, and their Q1 2026 earnings call.
And the reason we're looking at them is because this legacy fossil fuel era company might actually be the ultimate bottleneck for the entire future of tech.
It's a wild concept.
It really is a fascinating juxtaposition. I mean, for those who might not track the energy sector closely, Kinder Morgan is just an absolute titan of North American infrastructure.
Titan's almost an understatement, right?
Yeah, to put their scale in perspective, they operate roughly 78,000 miles of pipelines.
Oh, wow.
Yeah, 78,000. If you laid that out end to end, it would wrap around the Earth more than 3 times.
That is insane.
And they also operate 136 terminals. They move physical molecules, so natural gas, refined petroleum products, crude oil, even carbon dioxide.
And they store them in these massive quantities, too.
Exactly. They are basically the circulatory system for the American energy economy.
But historically, a company like this is viewed as a slow growth, dividend-paying stalwart, right?
Yeah, exactly. The kind of stock you buy for a steady 5% yield and then you just forget about it for a decade.
Right, but the quarter they just reported completely shattered that narrative.
Yeah.
They posted numbers that frankly look like they belong to a high-flying software startup, not, a mature midstream utility.
Yeah, the numbers are wild.
I'm looking at the headline numbers from the transcript right now, and they are genuinely staggering.
Yeah.
I want you to break down how a company that deals in dirt and steel and physical commodities pulls off this kind of quarter.
Okay, let's hear them.
So, adjusted earnings per share, or EPS, came in at 44 cents. That's a massive 41% increase year over year.
41%, that's huge.
Yeah, and net income was $976 million for the quarter alone.
Nearly $1 billion in a single quarter.
Right, and overall EBITDA grew by 18%. They even explicitly noted that they outperformed their own internal budget in every single business segment they operate.
Across the board beats.
Across the board. Plus, they declared a dividend of $0.2975 per share, so representing a 2% bump to an annualized $1.19.
It's a lot of data.
It is. I'm reading these stats, but you need to translate for us. How does a 1990s-style infrastructure giant suddenly post a 41% jump in earnings? And what is that adjusted EBITDA actually measuring in the real world?
Right. So let's strip away the acronyms and just look at the actual cash register.
Okay.
So EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Right.
In the heavy infrastructure space, you can essentially think of adjusted EBITDA as the pure raw cash flow generation of the business.
So the actual cash coming in the door.
Exactly. It's the actual money the operations are spitting out daily before the accountants start applying, non-cash charges.
Yeah.
And that last part is vital because when you build a multi-billion-dollar pipeline, it carries enormous depreciation charges on the income statement every year for decades.
Oh, because it's a massive physical asset degrading over time.
Right. And that depreciation can artificially drag down the standard net income figure. It makes the company look, less profitable than it actually is in terms of liquid cash.
Okay, that makes sense.
So when Kinder Morgan reports 18% growth in adjusted EBITDA, they're saying the raw underlying cash engine of the company is running 18% hotter than last year. And that is a torrential amount of capital.
Which brings up the other massive financial metric from the call, which is their debt.
Right, the leverage.
Yeah, their net debt to adjusted EBITDA ratio dropped to 3.6 times. And reading between the lines of the transcript, That is a historical milestone for them, isn't it?
It absolutely is. It's the lowest leverage ratio the Kinder Morgan entities have seen since well before their massive internal consolidation way back in 2014.
Wow. So to me, this 3.6 times ratio, it feels like paying down your mortgage 5 years ahead of schedule while simultaneously getting a massive promotion and a 40% raise at work.
That's a really good way to put it.
It's like the absolute dream scenario for personal finance, just applied to corporate finance.
The mortgage analogy is highly accurate, actually. The leverage ratio is simply their total net debt divided by that annual cash flow we just talked about. Okay. It tells the market how many years it would take the company to pay off every cent of its debt if it devoted all its operational cash to doing so.
So 3.6 years in this case.
Exactly. And to see an 18% growth in cash flow paired with a shrinking relative debt burden, that is incredibly rare in this sector.
Why is that?
Well, usually to get 18% growth, a pipeline company has to borrow heavily to build a new mega project, right? Which drives their leverage ratio up.
Oh, right. They have to take on debt to build the thing that makes the money.
Exactly. But Kinder Morgan is managing to organically grow the cash pile while actively de-risking the balance sheet at the same time.
And Wall Street noticed, right? I mean, Moody's bumped their credit rating up to a BAE1, which is the equivalent of a solid BBB plus across the major rating agencies.
Yep, they got the upgrade.
And that isn't just a gold star from the teacher, right? That actually changes the math on how they run the business.
It changes the math significantly. You can think of it as their corporate credit score crossing a major threshold.
Like getting above an 800 on your FICO score.
Exactly. When you operate in an industry where you regularly finance billion-dollar capital expenditures, the interest rate on your debt is one of your biggest single expenses.
Right. Even a tiny percentage is huge money.
Exactly. Shaving even 20 or 30 basis points off an interest rate when you're issuing $1 billion in bonds, that translates to tens of millions of dollars in pure savings over the life of that debt.
Just free money, basically.
Pretty much. And those savings fall straight to the bottom line, which gives them even more cash to pay down debt, hike the dividend, or fund new expansion. It basically creates a powerful, compounding, virtuous cycle.
Okay, so the financial house is immaculate. They have cash, their credit is stellar, and earnings are up 41%.
Yeah.
But wait, hold on a second. Because if I look deeper into the transcript, it seems like the biggest driver of this blowout quarter was quite literally the weather.
The weather argument.
Yeah, the natural gas segment drove the lion's share of the outperformance, and management specifically pointed to winter storms and extended cold snaps in the Northeast.
He did, yeah.
So I have to push back here. You can't budget for a blizzard, right? If next winter is exceptionally mild, doesn't this incredible 41% growth completely evaporate? I mean, isn't this just a lucky one-off fluke? And that is the perpetual skepticism analysts bring to midstream energy stocks. But answering it requires understanding the physical realities of the grid.
Okay, break it down for us.
Let's look at what actually happened on the ground. When severe extended cold hits the Northeast, heating demand spikes violently. Natural gas is the primary heating fuel in that region.
Right.
During this first quarter, the utilization on Kinder Morgan's top 5 natural gas pipelines hit over 90%.
90% capacity.
Yeah, these are massive high-pressure arteries of energy, and they were essentially running at maximum physical capacity day and night to keep cities warm.
And furthermore, it wasn't just the main transport pipes. Their natural gas gathering volumes jumped 15% compared to the first quarter of the previous year.
Okay, I've seen those terms in the earnings documents, but let's define them for the listener. Break down the difference between a transport pipeline and a gathering system.
Sure. Gathering systems are the localized, smaller diameter networks of pipes that snake out through the oil and gas fields. They connect directly to the individual wellheads.
So they're out in the actual oil fields.
Right. They physically gather the raw, unprocessed gas from the producers and funnel it to centralized processing plants.
Okay, and transport pipelines.
Transport pipelines, on the other hand, are the massive interstate highways of the system. They take the clean, market-ready gas from the processing plants and blast it across the continent to the end users, like city utilities or power plants.
Got it. And both of these systems saw massive volume surges.
Right. Gathering was up 15%, and their Haynesville asset in Louisiana was up a staggering 34%.
34%. But my question remains, I mean, if this is all driven by cold weather, how is that a sustainable business model?
Because the baseline revenue isn't dependent on the weather, only the upside is.
Oh, really?
Yeah, the underlying value of this infrastructure is a constant. Kinder Morgan operates the vast majority of its network on long-term fixed fee contracts.
Fixed fee, meaning they get paid no matter what.
Exactly. Customers pay a reservation fee just to guarantee they have space in the pipe, regardless of whether they flow gas that day or not. That is the steady heartbeat of their cash flow.
Okay.
The weather events act as a volatility multiplier. When extreme weather hits, the entire grid gets stressed, spot prices for natural gas skyrocket, and the value of having immediate physical access to transport and, crucially, storage goes through the roof.
Okay, so the fixed contracts cover the mortgage, but the weather events are like a massive year-end bonus.
Yes, exactly.
They essentially get paid an enormous premium for providing flexibility when the market is in a state of sheer panic.
You're hitting on the fundamental mechanic there. Kinder Morgan holds over 700 billion cubic feet of natural gas storage capacity.
That sounds like a lot.
It's an immense amount. When a winter storm paralyzes a region, local utilities are desperate. They need to pull gas out of storage instantly or push gas through alternative routes.
Right.
And Kinder Morgan is uniquely positioned to capture the value of that desperation because they own the physical toll roads.
Oh, I see.
It's not luck. It is having a massive, highly strategic net in the water. You don't know the exact week the school of fish will swim by, but your net is so large that when they do, you catch all of them.
That's a great analogy.
And as global climate patterns introduce more extreme temperature swings, both hot and cold, that built-in system flexibility becomes increasingly valuable every single year.
Yeah, that structural advantage makes a lot of sense. And speaking of capturing value, I want to talk about their terminal segment.
Oh yeah, the terminals.
Because this was my absolute favorite part of the earnings call. It just highlights pure management ingenuity. They reported 99% tank usage at key liquid storage hubs, like the Houston Ship Channel and Carteret in New Jersey.
Meaning there's virtually zero spare capacity.
None at all. But the real magic was a specific transaction at their Pasadena terminal.
Ah, the Pasadena lease buyout. It is a brilliant piece of asset management.
Okay, let me explain how I read this, and you tell me if I have the mechanics right.
Go for it.
So they had a commercial customer who wanted to break their liquid storage lease early. So Kinder Morgan required a lump sum cash payment as an early termination penalty.
Better practice, yeah.
Right. And that cash hit KMI's balance sheet in Q1, providing a nice earnings bump. But instead of letting those massive steel tanks just sit empty, the terminal management team immediately turned around and released that exact same capacity on the spot market.
Immediately.
Yes. They found short-term customers to fill the tanks right away while simultaneously locking in brand new long-term contracts for the future.
And the rates on those contracts.
Right. Those new contracts actually have rate step-ups, meaning the customer pays more over time as Kinder Morgan improves the physical connectivity of those tanks to the broader Houston network.
Your reading is perfectly accurate. It demonstrates incredible commercial agility.
The analogy I came up with is like being a landlord in a hyper-competitive housing market.
Okay, I like this.
So you own a highly desirable apartment building. A tenant comes to you and says, hey, I need to break my lease a year early. Here is the $10,000 penalty fee.
You take the cash today.
Exactly. But because the rental market is so hot, you instantly put the unit on Airbnb to cover the next 2 months at a massive nightly premium.
Right.
And while the Airbnb guests are in there, you sign a new long-term tenant who is moving in 3 months from now, paying 15% more in monthly rent than the guy who originally broke the lease.
That's amazing.
You got paid for the empty space, you got paid a premium to fill it short term, and you raised your long-term revenue baseline.
It is the ultimate landlord maneuver. And the critical takeaway for an investor here is that you cannot pull off that kind of sequence unless the underlying market fundamentals are incredibly tight.
What do you mean by tight?
I mean, if there were empty storage tanks all up and down the Houston Ship Channel, that original customer could have easily found cheaper alternatives. And KMI wouldn't have had the pricing power to immediately release at higher step-up rates.
Oh, true. They have the leverage.
It proves that their physical assets are in the exact locations where the global market desperately needs them to be.
Which perfectly transitions us into how they're expanding that physical footprint. Because they didn't just manage their existing assets well this quarter, they actually went shopping.
They did.
They announced a $500 million acquisition of the Monument Pipeline System in Texas. Now, $500 million is a serious chunk of capital.
Yeah.
Why this specific pipeline and why right now?
The Monument Pipeline deal is a masterclass in strategic bolt-on acquisition.
Bolt-on?
Yeah, they aren't trying to plant a flag in a brand new, unproven geographic region. They are reinforcing a stronghold they already dominate.
Oh, I see.
This specific pipeline system runs right through the industrial heart of Texas, specifically integrating into the corridor from the Houston area down to Corpus Christi. The executive team emphasized that this system integrates perfectly on a last-mile basis.
Right. Last mile is a logistics term. We usually hear it with, like, Amazon packages getting from the local warehouse to your front porch.
Yeah.
How does that apply to a high-pressure gas pipeline?
It's the exact same concept, just scaled up to heavy industry. So Kinder Morgan already owns the massive interstate highways, the transport pipelines bringing huge volumes of gas down from the shale basins.
Okay.
But delivering that gas directly into the complex web of petrochemical plants, refineries, and export facilities along the Gulf Coast, that requires intricate, smaller-scale pipeline networks that snake through dense industrial zones.
Oh, so the Monument Pipeline is that smaller network.
Exactly. The Monument Pipeline acts as that local delivery network. It provides direct, physical off-ramps from Kinder Morgan's main highways right to the factory doors of major industrial consumers.
Got it. And there was a very specific, highly technical phrase used on the call regarding the gas in this pipeline. Management called it incremental non-nitrogen supply.
Yes, that's a very important detail.
I mean, I'm an investor, not a chemical engineer. What does that actually mean, and why is it worth $500 million?
This is where understanding the physical commodity really matters. Natural gas is primarily methane, which is what burns and creates heat.
Right, methane.
But raw natural gas comes out of the ground mixed with other elements, including nitrogen. Now, nitrogen is an inert gas. It does not combust.
Doesn't burn.
Right. If you have a pipeline flowing with high nitrogen gas, you have two major problems. First, nitrogen takes up physical space in the pipe.
Like filler.
Exactly. It reduces the total volume of combustible fuel you can move. You are literally spending energy to compress and transport a gas that does absolutely nothing.
Wow, that's super inefficient.
Very. And second, it lowers the heating value, often measured as the Wabi index, or just BTUs of the delivered product.
Okay, so it waters down the fuel.
Exactly. And industrial customers along the Texas coast, like chemical manufacturers or power plants, they run highly calibrated equipment. They need premium, high-heat gas to run efficiently.
So they don't want the nitrogen filler?
No, they don't. By acquiring a system that secures non-nitrogen supply, Kinder Morgan is essentially buying a pipeline that delivers a premium, highly combustible grade of fuel, and industrial buyers are willing to pay top dollar for that.
Wow. So they're eliminating dead weight in the circulatory system and delivering a higher octane fuel to their best customers.
That's a great way to put it.
But beyond the chemistry, what do the underlying financials of this deal look like? Are they hoping customers show up, or is the revenue locked in?
This is the safest kind of acquisition. It is entirely backed by existing commercial agreements. The pipeline comes with long-term contracts already actively in place.
Okay, so they bought the pipeline and the customers.
Exactly. Management noted the weighted average contract life is about 9 years.
Yeah.
And crucially, 90% of those contracts are with utility and industrial customers who hold strong investment-grade credit ratings.
So these aren't fly-by-night operations. They're going to pay their bills.
Right. Kinder Morgan isn't speculating on future demand. They are buying a mathematically guaranteed cash flow stream that stretches out for the next decade.
That's incredibly stable.
And furthermore, because this new pipe physically touches Kinder Morgan's existing storage assets in the region, KMI can route gas and optimize storage in ways the previous independent operator simply didn't have the network to do.
So the asset is quite literally worth more on Kinder Morgan's balance sheet than it was on the seller's.
Yes. A lot more.
Okay, we have unpacked a phenomenal quarter. We've got weather-driven volume spikes, genius-level real estate management at the terminals, and a highly strategic $500 million acquisition that locks in a decade of premium cash flow.
It was a very busy Q1.
It really was. But as retail investors, we can't buy past performance. We have to look through the windshield.
Right. What's next?
Let's look at management's forward guidance and the macroeconomic environment. Because the transcript for this section genuinely read like a speculative sci-fi novel about the future of the global economy.
It really did.
So management updated their 2026 outlook, and they now expect to beat their full-year EBITDA budget by more than 3%.
Yep.
That translates to over $250 million in extra unplanned cash flow for the year. And they were very careful to state that this extra $250 million does not even include the new revenue from the Monument acquisition, which hasn't officially closed yet.
Right, that's just organic beat.
And they also expect to end the year with leverage at 3.7 times, beating their original budget of 3.8.
So financially, the rest of the year looks bulletproof.
Very strong.
But here is the statistic from the call that forced me to stop reading and double-check the math.
The AI numbers. Yes. Richard Kinder, the executive chairman, was discussing the future of natural gas demand. He cited a report from S&P Global Market Intelligence.
Okay.
Utilities in the United States currently plan to add a staggering 153 gigawatts of new gas-powered generation capacity in the next several years, primarily to serve data centers, with the bulk of it coming online by 2030.
By 2030.
Yeah. That estimate is double what it was just 1 year ago, and it requires building roughly 210 brand new natural gas-powered power plants.
It is a genuinely astronomical figure, and to truly grasp the scale of what 153 gigawatts represents, we really need to contextualize the unit.
Please do, because gigawatts just sounds like Back to the Future to me.
Right, 1.21 gigawatts. So a single gigawatt of power is roughly enough to provide electricity for a mid-sized American city of about 750,000 homes.
Wait, are you serious?
I am.
So the utility sector is planning to build enough new power generation to run 153 mid-sized cities.
Basically, yes.
And they have to do it by 2030. That is less than 4 years away. How is this massive surge in demand happening so suddenly?
The catalyst is the exponential evolution of artificial intelligence.
Like ChatGPT and all that.
Exactly. Traditional internet infrastructure, cloud storage, standard Google searches, streaming video, it requires a predictable amount of power.
Okay.
But generative AI models, particularly large language models, require a quantum leap in computing power to train and operate. We're moving from server racks that require maybe 10 kilowatts of power to high-density AI racks requiring 50, 100, or even more kilowatts per rack.
That's a 10x increase in power density.
Easily. And they run so incredibly hot that traditional air conditioning fails.
Yeah.
They require advanced liquid cooling systems.
Oh.
The tech industry, so Amazon, Microsoft, Google, Meta, they are racing to build these hyperscale data centers all over the country to win the AI arms race. But they have collided headfirst with physical reality. The existing U.S. electrical grid simply cannot handle the load.
But wait, all these massive tech companies have strict ESG goals. I mean, they all pledge to be carbon neutral or run on 100% renewable energy by 2030.
They did, yes.
So why aren't they just building massive solar farms and wind turbines next to these data centers? Why are they forcing the construction of 210 new fossil fuel power plants?
Because of the ruthless physics of baseload power.
Baseload power.
Yes. Wind and solar are excellent supplemental energy sources, but they are inherently intermittent. The sun goes down, the wind stops blowing.
Right.
If you are operating a multi-billion-dollar AI data center running complex algorithms 24 hours a day, 7 days a week, your uptime service level agreement is usually 99.99%.
5 nines.
Exactly. You cannot allow a facility to power down because a cloud passed over your solar array. To run a data center on renewables requires battery storage at a scale that simply does not exist yet commercially.
So they need juice that never turns off.
Right? They need reliable, always-on baseload power. And in the United States today, the only way to rapidly scale up reliable baseload power at the gigawatt level is natural gas.
Wow.
A gas turbine power plant can be spun up in minutes to meet a surge in demand, and the fuel that feeds those turbines has to come from somewhere.
It has to come through a steel pipe.
Bingo.
This is the grand irony of the AI revolution. Silicon Valley's quest to build, the futuristic digital brain of tomorrow is entirely tethered to a 19th century physical commodity.
It's an incredible paradox.
I originally thought of natural gas as the picks and shovels of the AI gold rush, but that analogy is too passive. Kinder Morgan's pipeline network is more like the central nervous system carrying glucose to a rapidly growing, incredibly hungry AI brain.
That's a very accurate biological metaphor.
Without the glucose, the brain dies. Big tech companies can bid up the valuations of AI software startups to the moon, but none of those algorithms can execute a single line of code without electricity. And that electricity is increasingly going to flow through Kinder Morgan's infrastructure.
It represents a foundational friction in the modern economy, and the financial markets are really just beginning to properly price it in. Kinder Morgan's internal forecast for U.S. natural gas demand has been officially extended through 2031, and they are now modeling for demand of 150 billion cubic feet per day.
Wow.
Yeah, that represents a 27% growth from current levels. It is a tidal wave of demand coming directly at their asset base.
And it isn't just domestic data centers causing this surge. The earnings call highlighted a massive international component. Let's pivot to the global dynamics regarding LNG, or liquefied natural gas.
Yes, LNG is the other massive piece of the puzzle.
You caught a fascinating macro detail buried in the executive commentary about global shipping and geopolitics.
I did. The executive chairman specifically called out the geopolitical instability in the Middle East as a major long-term tailwind for their business.
How does that work?
He pointed to recent damage at Qatari liquefaction facilities and the persistent, escalating uncertainty regarding commercial shipping traffic through the Strait of Hormuz.
Right. But to understand why this matters to a pipeline company in Texas, we really have to look at the global map.
Exactly. Qatar is a heavyweight champion of global LNG exports. They share the massive North Field with Iran. However, to get their LNG to buyers in Asia or Europe, their massive tanker ships must navigate out of the Persian Gulf through the Strait of Hormuz.
Okay.
It is one of the most vulnerable geopolitical choke points on the planet. If those facilities suffer physical damage, or if global buyers simply become terrified that tanker ships cannot safely navigate the strait due to regional conflict, the entire global energy market panics.
Because countries like Japan, South Korea, and Germany absolutely rely on imported LNG to keep their economies functioning.
They do. They have very little domestic supply.
Right. So if the Middle Eastern supply chain looks fragile, they have to look elsewhere.
Precisely. They desperately seek safer, more reliable sources of energy. And currently, the United States is viewed as the ultimate geopolitical safe haven for energy supply.
Makes sense. We have massive domestic reserves.
Right. Massive reserves, stable rule of law, and crucially, export terminals located on the Gulf Coast that have direct open ocean access to the Atlantic and the Panama Canal. They completely bypass the world's major conflict zones.
So this global anxiety is heavily driving long-term international preference toward U.S.-sourced LNG.
Exactly. But the gas doesn't magically appear at the ships. It has to travel from the Permian Basin in West Texas or the Haynesville Shale in Louisiana down to the massive coastal export terminals.
And that journey requires midstream infrastructure.
It does. This is exactly why Kinder Morgan reported an 8% increase in natural gas transport volumes in Q1 alone, driven overwhelmingly by increased feed gas deliveries.
Okay, let's define feed gas for the listener. That refers to the raw natural gas being pushed through the pipes directly into those massive multi-billion-dollar coastal facilities.
Right.
And at those facilities, the gas is supercooled to minus 260 degrees Fahrenheit until it condenses into a liquid. This reduces its volume by a factor of 600, so it can be pumped onto specialized ships and sent across the ocean. Kinder Morgan owns the umbilical cords feeding those coastal refrigeration plants.
That is a perfect visualization. And as more of these LNG export facilities come online along the Gulf Coast over the next 5 years to meet international demand, the volume of feed gas required is going to multiply.
So the macro picture is almost absurdly bullish. I mean, we have a domestic grid being aggressively starved for power by the AI data center arms race, combined with a global market terrified of Middle Eastern instability and clamoring for U.S. LNG exports.
It's a perfect storm of demand.
It really is. So what does this actually mean for Kinder Morgan's future construction plans?
Well, they gave some big numbers on the call.
Yeah, management discussed their project backlog. Their expansion project backlog grew to $10.1 billion this quarter.
$10.1 billion.
Yeah. They put $230 million worth of finished projects into service, but they added $375 million in new projects. And here is the phrase that caught everyone's attention. The new additions included 3 specific data center energy deals.
There it is. The AI impact showing up in the balance sheet.
Exactly. The average in-service date for this massive $10 billion backlog is Q1 2028.
Okay.
But I have to play the skeptic again here. A $10.1 billion backlog sounds fantastic in a press release. It looks great on a slide deck.
Sure, analysts love a big backlog.
Right. But as an investor, I know that building heavy infrastructure in the 2020s is incredibly expensive, highly politicized, and notoriously difficult.
Oh, absolutely.
I mean, permitting is a nightmare, environmental opposition is fierce, and lawsuits can drag on for a decade. Are these projects actually going to get built and generate a return on investment, or is management just selling a Wall Street dream to pump the stock price?
This is perhaps the most critical distinction for any retail investor to understand about Kinder Morgan's specific corporate culture.
Okay, lay it on me.
When this management team talks about a project being in their backlog, it is not a wish list. It is not a concept drawn on a napkin in a boardroom.
Right.
During the Q&A portion of the earnings call, a financial analyst specifically asked about a proposed joint venture project called the Western Gateway. And they asked whether the capital for that project was included in the $10.1 billion figure.
What do they say?
Management firmly stated no. They explicitly reiterated that projects do not enter the official backlog until they reach FID.
FID, final investment decision. Why is that such a crucial threshold in this industry?
Reaching final investment decision means the project has passed every internal engineering and economic hurdle. But far more importantly, it means the commercial support is legally locked in.
So the customers have already signed on the dotted line?
Yes. Kinder Morgan does not operate on a speculative, build it and they will come philosophy. They refuse to take volume risk on new mega projects.
Volume risk, meaning they build it and hope enough gas flows through it to pay for it.
Right. Before they put a single excavator in the dirt, before they order the miles of steel pipe from the foundry, they require legally binding agreements with customers. And these are usually highly rated utility monopolies, massive industrial players, or the major tech companies themselves.
And these are structured as take or pay contracts, right?
Yes, take or pay contracts.
Okay, take or pay, meaning the customer agrees to reserve a specific amount of volume on that pipeline for the next 10, 15, or even 20 years.
Right.
And if the customer's business slows down and they don't actually need to flow any gas that month, they still have to pay the reservation fee to Kinder Morgan anyway.
Exactly. The take-or-pay structure completely shifts the economic risk away from Kinder Morgan and onto the end user. Kinder Morgan is essentially securing a guaranteed corporate annuity before they even begin construction.
That is incredibly de-risked.
It is. So when they announce a $10.1 billion backlog, they aren't selling a speculative dream. They're reporting a legally contracted, highly visible future revenue stream.
So the risks are no longer will customers use it.
No, that risk is gone.
The only remaining risks are execution. So can they construct it on time and on budget? And regulatory, can they secure the permits?
Exactly. And on the call, management was keen to note that their three largest pipeline projects, which account for over 50% of that total backlog, are currently tracking exactly on time and on budget.
In regarding the regulatory risk, Richard Kinder made a surprisingly blunt comment during the Q&A that revealed their entire philosophy on where they build.
Oh, about New England?
Yeah. An analyst asked about the potential for expanding pipelines up into New England. And we all know New England desperately needs more natural gas infrastructure. They rely on imported oil during extreme winters because they don't have enough pipeline capacity from Pennsylvania, which leads to massive price spikes for consumers.
Right. It's a known issue.
But Kinder basically shot the idea down. He said, look, the fundamental need is clearly there, but we need absolute certainty on state-level permitting, and we need commercial support from local utilities that are legally allowed by their public utility commissions to sign 20-year contracts. He literally said, somebody's going to have to roll out the red carpet.
Yeah, that was a very telling quote.
They are outright refusing to fight protracted regulatory battles on speculation. They've written off hundreds of millions in capital doing that in hostile jurisdictions in the past, and they have learned their lesson.
Completely.
They have so many lucrative opportunities in infrastructure-friendly jurisdictions, Texas, Louisiana, the broader South, the Gulf Coast, that they do not need to force projects where local politicians don't want them. They only deploy capital where the money is guaranteed and the regulatory path is completely clear.
It represents a highly disciplined, almost ruthless approach to capital allocation. They also noted that the EBITDA multiples on these expansion projects are highly attractive, meaning the cost to build the pipeline versus the annual cash flow it generates is a very favorable ratio.
So they're getting good bang for their buck.
Extremely good. And because their baseline cash flow is so incredibly strong right now, as evidenced by that 18% growth we discussed at the top of the show, they can finance the vast majority of these new billion-dollar projects using internally generated cash.
Wow. They don't even need to borrow the money.
No, they do not have to go to the bond market to take on massive new debt, and they don't have to issue millions of new shares that would dilute the ownership of current retail investors.
It's a self-funding, compounding growth engine.
Yeah.
Okay, we have thoroughly unpacked the mechanics of this quarter. We've broken down the blowout financial numbers, the genius real estate maneuvering at the terminals, the underlying chemistry of the Monument pipeline deal, and the massive, inescapable macroeconomic tailwinds of AI data centers and global LNG demand.
We covered a lot of ground.
We really did. So it is time for the bottom line. As part of our Talk Tickers mandate, we synthesize all of this data to deliver an opinionated, actionable verdict for you, the retail investor holding or considering this stock.
Let's hear it.
Based on this deep dive, the signal here is definitively, unapologetically bullish. We are looking at a company that is often priced and traded like a boring, slow-growth utility, but is actually positioned as the inescapable physical bottleneck for the two biggest global energy stories of the decade: the AI data center power crisis and the permanent global shift toward U.S. liquefied natural gas.
That's a very strong thesis.
For retail investors, KMI presents a rare asymmetric opportunity. It is a low-risk way to capture the massive economic upside of the AI energy boom without having to pay a nosebleed, 50 times earnings premium for a speculative software or a semiconductor stock. You get the growth narrative, you get a balance sheet that is unequivocally the healthiest it has been in over a decade, and you get paid a safe, growing dividend yield of nearly 6% cash while you wait for the $10 billion project backlog to officially come online and boost earnings even further.
It is a remarkably compelling investment thesis. The downside risk profile has been aggressively and systematically managed downward through relentless debt reduction and disciplined capital allocation. Meanwhile, the upside optionality has expanded dramatically, driven by systemic macroeconomic shifts that are entirely outside of the company's control, but perfectly aligned with their physical asset base.
Exactly.
But I want to turn this analysis over to the listener for a moment. As you digest all of this, what stands out to you? Is it the sheer overwhelming scale of the 153 gigawatts of new power demand required by the AI revolution? Or is it the conservative, disciplined financial management of the company itself? Their absolute refusal to put shovels in the dirt without take or pay contracts, and their relentless focus on driving down the leverage ratio even during a period of massive growth.
Both are incredible.
They are. It is exceedingly rare in public markets to find a heavy industrial company exhibiting both aggressive pipeline expansion and defensive balance sheet contraction at the exact same time.
It really is a unicorn quarter in the infrastructure space. And I want to leave you with one final provocative thought to mull over as we wrap up. We started this deep dive by noting the irony of looking at a rusted steel pipeline company as a backdoor AI investment.
Right, the pipes versus the servers.
But think about the broader implications of what we just discussed. If the most cutting-edge, futuristic, trillion-dollar tech industry on the planet is suddenly realizing they need to facilitate the construction of over 200 new physical, heavy industrial natural gas power plants just to keep their AI servers from going dark by 2030, what else are we missing?
That's a huge question.
How long until other forgotten legacy infrastructure sectors, so copper mining, electrical transformer manufacturing, heavy water purification experience, a similar, massive, hidden, tech-driven renaissance?
There's definitely going to be ripple effects.
We spend so much of our time and capital focused on the sleek software of the future, we might be fundamentally underpricing the massive amounts of physical 19th century hardware required to actually run it. Keep your eyes on the physical world. Thanks for taking the plunge with us on this Talk Tickers deep dive, and we'll see you next time.